Welcome back traders to another exciting episode of our channel. In today's video, we're diving deep into the captivating world of Candlestick Mastery. Get ready to unlock the secrets of predicting market reversals with precision. Whether you're a seasoned trader or just starting your journey, understanding candlestick patterns is essential for spotting potential trend shifts and making informed trading decisions. In this comprehensive guide, we'll take you step by step through the most powerful candlestick patterns and teach you how to harness their predictive potential. Steve Nison, your guide on this enlightening journey, with years of experience in the financial markets, have honed his skills in analyzing candlestick patterns to identify high-probability opportunities. In this video, he is sharing his insights and techniques to help you achieve mastery in this crucial aspect of trading. From classic patterns like doji, hammer, and engulfing to more complex formations, such as evening star and hanging man, we'll demystify each one and equip you with the tools to anticipate market reversals like never before. But that's not all. We'll also explore advanced strategies, combining multiple candlestick patterns to validate our predictions and optimize our trading decisions. Get ready to witness the precision and accuracy of candlestick mastery. Our goal is to empower you with the knowledge and skills to confidently navigate the ever-changing financial landscape and stay ahead of the competition. So, whether you're a swing trader, day trader, or long-term investor, this video is packed with invaluable insights that will elevate your trading game to new heights. Stay tuned as we delve into the fascinating world of candlestick patterns and discover how to predict market reversals with precision. Are you ready? Let's dive in and unlock the secrets of candlestick mastery together. Forex Central, where traders become masters.
Hello, this is Steve Nison. Welcome to a special bonus for the DVD workshop Profiting in Forex Using Candlesticks to Catch the Next Move. The Japanese have a wonderful proverb: to hear it told is not equal to experience. And this is where you get your experience. This bonus session will have interactive Q&A charts, we'll have case studies, and we'll have slides. I'll say, for example, what would you do next? And this is a great way to really test and refine some of the critical aspects you learned during the entire DVD workshop. So let's move on to the first one. We have three potential reversal signals here. What are they? And what I'd suggest you do is think about the questions. We'll have a little sign like this that'll come up, and you could hit the pause button to think about the answer. When you're ready to hear me give my answers, just resume the play of this DVD. So what I would do now is pause now. Okay, so let's go through the answers. Okay, we have a doji. We'll discuss the bearish harami in a couple of minutes, but a doji is when the opening and closing are the same or nearly the same. Remember, in the Forex market, as discussed in the DVD workshop, even if there's a small real body, the Japanese call a small real body a spinning top, even if it's very, very small, we would view it the same as doji, because different charting services, one might have a doji, another one might have a spinning top. So I equate a doji and a very small spinning top as being one and the same. So here we have a doji, and a doji tells us the prior trend is running out of steam. What was the prior trend, the immediately preceding trend? That was correct, up. Okay, remember, when we talk about a potential trend reversal, we look at the immediately preceding trend, even if it's only 3, 4, or 5 candlesticks. And with the doji, the Japanese would say that the market is tired. So the first one is a doji. The second one is a bearish harami. And a bearish harami is a small real body within a long real body. So here, obviously, we have the doji within the long white real body. This, by the way, is called a harami cross, if it happens to be a doji, but I just normally refer to it as a harami. So we have the bear harami over here. And the last, but certainly not least, is the bearish engulfing pattern. That's when a black real body wraps around a white real body. And remember, in the Forex, even if the opening of the black candle is the same as the prior close, which it'll be very often because the Forex is a 24-hour market, this is still fine as a bearish engulfing pattern. So here are the three. And actually, another one we can think about is a resistance area. Now, one of the things that we could do with doji is we could make the high between the doji and the prior candle potential resistance. So which has the higher high? Over here. So we make a horizontal line, and although the market pushed above the red resistance line, did it close above it? And the answer, of course, is no. So we could add that as another signal that potentially the market was running out of steam. And also, of course, just like with a bar chart, everything we do with a bar chart, we could do with a candlestick chart. The market was going from higher highs, right? And so we're going from higher highs to about the same highs. So we see the bullish strength is losing momentum. Okay, over here, what are the three candle signals at 1 in that red semicircle that are hinting the bulls are losing momentum? And there was something else that warned the market was stalling at this area 1. So once again, just put the player on pause, think about the answers, and then resume when done. Okay, so let's go through these. What are the three signals at 1? Okay, first is a spinning top. And the spinning top is a small real body. Okay, to me, it's almost the same as a doji. This is very similar to the prior chart, correct? You know, with the small real body that was so small that was a doji. So we have the doji telling us the immediately preceding trend, in this case, was higher. Okay. By the way, some of you may recognize this signal here. It looks like a dark cloud cover. Just to refresh your memory, a dark cloud cover, the market's ascending. Then we have a black real body that gets more than halfway into the white real body. This did not get more than halfway into the white real body. If we see something like this, where it doesn't get more than halfway into the white real body, normally the next session for confirmation, I'd want to see a close under the middle of the white real body, and obviously we didn't get this, so this was not a dark cloud cover. So here we have the spinning top. Okay, there's a tug of war between the bulls and the bears, so the trend is going from up to a little bit more neutral. Then we have the doji over here. And of course, very similar to the prior one, small real body and a big real body. This is a harami. So we have three potential signals here. Now, what else warned that the market was stalling at area 1? A resistance line. All the highs were exactly the same. So we had a grouping of signals: the spinning top, the doji, the harami, and the resistance line. As mentioned here, resistance. Now, what is the candle signal here at 2? And again, think about this for a while. And anything else to get us nervous. So what I would suggest you do is, once again, pause now and resume when done. Okay, so the candle signal at 2, you all should get this. This was a shooting star, refresh your memory, very long upper shadow, small real body at the bottom end of the trading range, and it's okay to have a very small lower shadow. So this real body, by the way, could be black or white. So that was one of the answers. The candle signal at 2 is a shooting star. And what else would get us nervous? Now, think about this. Wasn't this a resistance area? Remember we talked about resistance over here, right? But the market got above resistance. Well, if you remember on the DVD workshop, one of the things we discussed, one of my favorite Western charting techniques, is when the market breaks above a clean-cut resistance area. And this certainly was a very obvious and very exact, it doesn't have to be, but there's an exact resistance area where time after time the market stalled near 194.50. One of my favorite bearish signals is when the market breaks above it and can't hold above it. Remember, that was called a falling off the roof. So here, the market pushed above resistance. Now, if the bulls really had control of the market, they really should have maintained the pound above this resistance area, and they couldn't do it. This was their shot, and they failed. So this was a failure to hold over resistance, a false breakout, what we call a falling off the roof, and that was a very, very great short sale. So we had such a confluence of indicators. We have the spinning top, the doji, the harami, the shooting star, the failure to hold above resistance area, and this is what we want, a grouping of indicators. So these all combine to give us a great short selling opportunity. Okay, moving on. Now you'll see this is case study 2, part 2. Okay, the first slide discussed previously was case study 1. And now we're going to be looking at part 3. This is the same slide. So, is 3 a hammer? Okay, again, think about this. Definition of a hammer. Okay, the answer is no. The upper shadow is too long. If we had a very small upper shadow, that would fit the definition of a hammer. So 3 is not a hammer. But although it's not a hammer, what pattern does 3 complete? And think about that. I'm not going to put the sign up that says, pause now. Just think about it for a second or two. Okay, it's a bullish harami. This was a bear harami. Remember, the market's moving up. We have a small real body and a long real body. Now, remember, with the Forex market, the second real body normally is going to be the opposite color of the first real body. In non-Forex, it doesn't matter if the color is the same. But because the opening here is almost always going to be nearly the same as the prior close, the only way this could be a harami, in other words, it's a spinning top, is this is a black real body. In the like vein, a bull harami, because the opening here is going to be the same as the close, the only way this could be a small real body inside the prior black real body is if this is a white real body. So this white real body is in prior black real body. This is a bullish harami. Remember, the harami is not a major reversal signal, but it is a sign, as the Japanese would say, that the prior trend is losing its breath. So the prior trend before this bull harami at 3 was down, so that's giving us a clue that the preceding downtrend was losing some downside momentum. Now, let's go to part 4. Okay, what pattern is 4? And once again, let's just put the player control and pause. Okay, so what pattern is 4? If you said bullish engulfing pattern, wrong. And the reason for that, the trend is wrong. Remember, a bullish engulfing pattern must come after a downtrend. Remember, one of the concepts is that we not only have to have the shape of the candlestick line or the pattern. Remember, a pattern is made of more than one candlestick line, but we also need the trend. So a bullish engulfing pattern must come after a downtrend, even a short-term downtrend. This particular candlestick signal came after a rally. So this is not a bullish engulfing pattern. And let's look at part 5. What pattern is 5? Put the player control and pause to think about it. Okay, pattern 5. If you said bearish engulfing pattern, you're right. It's a bearish engulfing pattern because the short-term trend, even if you looked at even this little rally here, but certainly from here, the short-term trend is up. A bearish engulfing pattern comes after a rally, and this was certainly a rally. It's a black real body wrapping around a white real body, coming after an uptrend, so that meets both those criteria. So very interesting how we got a group of signals right around the same level here. Okay, the spinning top, the doji or shooting star, the bearish engulfing pattern. By the way, this group of signals here, this is not quite a harami, although this is a real body in a long real body. The second real body has to be much smaller than the first real body. And if you want kind of a general rule, it should be about 25% or less of the long real body. So you can see how this was certainly 25% or less of this real body, as this harami also here was 25% or less of that real body. So this was certainly not 25% of this tall white real body. So moving on, okay, what candlestick indicators were there at 1 to 4? So hit the pause control now. Okay, so let's go through these one at a time. 2 shooting stars, okay, coming after a little uptrend here. It's a little uptrend, 2 shooting stars. And one of the things we could do with the candlestick signals is make them resistant. So we could take the higher shooting star, and that becomes a resistance area. And even if you use this high here as potential resistance, see how the market got to the resistance. Let's use this one. Even though it got above it, it didn't close above it. Remember, to break a resistance area, the market has to close above resistance. 2, this I would view as a harami, bearish harami, because that second real body was certainly 25% or less of the first real body. 3, over here, just to make it a little easier to see in the green semicircle, what is that? That's right, a bearish engulfing pattern. Comes after an uptrend. So 3 is a bearish engulfing pattern. And 4, didn't the market poke its head above resistance? Now remember, in one of the prior slides, I mentioned one of my favorite Western indicators. Remember, market breaks above a really clear-cut resistance area, and we certainly had that resistance as shown by these dual red lines. So 4 essentially was a falling off the roof. In other words, a failure to hold the new highs. And just to refresh your memory, we get a target with a falling off the roof. As soon as the market gets back under the broken resistance area, we set our stop here, our protective sell stop if we're short, and our target is a return to the most recent low, in other words, where the rally began. So our target would be down there. So that would have been a very attractive risk reward. Okay, now let's move on to case study 4. Okay, what are the signals here hinting us of some trouble? And once again, just hit the pause control. Okay, so first we have the doji. Now, because this doji is also within the prior candle, it's also harami. We've seen quite a few of those in the prior slides. Next is a bearish engulfing pattern at 2 with the black candle wrapping around the white candle. At 3, another bearish engulfing pattern. And 4, the same resistance area. So we have a grouping of indicators all converging at the same level. Now, we're going to be looking at this slide again, or this chart again. And so these are, by the way, these are the signals, the doji, the harami, the bearish engulfing pattern at 2 and 3, and the resistance. Now, the question is, for part 2 of this case study, would you sell at 3? And put the player control on pause and think about that. Remember, we don't know what happened, after the, action here. We don't know the market sold off, so forget about all of this stuff. If we were at this juncture here, would you be selling? So think about it. Okay, so let's move on. Would you sell at 3? Okay, first of all, notice, and again, let me just take this out here. We're going to forget about all this stuff. So we're only at time frame 3. So first of all, although we have a grouping of signals, the doji, the bearish engulfing pattern, the resistance area, keep this in mind. If we're selling at 3, notice these 2 black horizontal lines. Isn't the market at support? Okay, remember, we don't know the market broke under support the next session. So if you're selling at 3, you're really selling at a support level. So, one of the things you should be looking at is, no, I wouldn't be selling it because it's at a support level. Maybe the next session with the market closing under the support area, we could think about selling it because the market broke a support area. Do we sell here? By doing so, in other words, do we sell here? We have to see if the market is near a support area. And obviously, we'd have to go back a little bit further on the chart to see if the market indeed is at a support area here. If not, then it's perfectly fine to be selling it here because, 1, the market broke under the support area. 2, it also broke out of an expanding top. I really like it when the market builds a top or expands on a top or expands on a base, from a bottom, because it really showing that the market is going from up to neutral, and by the break under this neutral area, it's confirmed that the bears have taken over. On the flip side, if the market's selling off, and then we have a base being built, and the market closes above the base, I really like that because you've expanded on a base for a more substantial rally. Normally, the bigger the base, as a general rule, the bigger the base, the better the rally. So let's move on to case study number 5, and these are Fibonacci retracements. Okay, so let's look at some questions here. And once again, we're going to have like part 1, part 2, and part 3, and so forth for case study 5. So, what are the reversal signals here in the red rectangle that I'm highlighting here with the arrow? Okay. Question 2 is, what pattern is this? Okay, at the lows. Okay, that is down, and just to make sure you see it down here. Question 3, what are the reasons for caution here? So, put the player control on pause and think about the answer over the next couple of minutes. And there's going to be a 3-part answer, okay, because we have 3 questions. Part 1, okay, what are the turning signals? The high wave candle. Refresh your memory. High wave candlestick line with a very long upper shadow and very long lower shadow. The market's lost its sense of direction because it rallies. The upper shadow shows you it rallies and then sells off. The lower shadow shows that it sells off and then rallies. So we have a high wave candle, also a spinning top, a small real body. That's one aspect. 2, we have a series of bear shadows. That's long upper shadows, some bearish shadows, visually showing us that the market's rejecting higher levels. Also, some more small real bodies. I had noted with the high wave candle, there was also a small real body, a spinning top. Remember, those terms are the same, spinning top, small real body. And here we're having a group of all these spinning tops also. So although the market's holding the highs fairly well, we're getting lots of visual signals of some problems overhead. And also, I should mention the bearish engulfing pattern. So a whole group of reversal signals there. This bearish engulfing pattern was interesting because it was a black real body that wrapped around two white real bodies. That increased the likelihood of the market turning. Now keep in mind that because candlesticks don't give us price targets, you could have a black real body like this wrapping around 20 white real bodies. It doesn't mean the market's going to go from 121 down to 115 as in this case, but this is the dollar yen. But it does increase the likelihood of the market turning. It also does make that area more substantial resistance. And indeed, if you look at this was a fairly important resistance area because the market got near there and stalled. So let's move on now to part 2. Okay, what pattern is down here? And it's related to the bullish engulfing pattern, but this white candle didn't quite wrap around the black real body, so the answer to this is it's a piercing pattern. Okay, potential bottom reversal signal. And let's go to part 3 here. What are some reasons for caution? And what I showed is the reason I have the term Fibonacci retracements here is because it does come into play in this part of the question. Now, one of the great things about the candlesticks is that we can add all Western tools, and Fibonacci retracements are very popular in the Forex market. So, think about the answer to this one, some reasons for caution. One, when you're a 50% Fibonacci retracement. Okay, that's to me is the most important Fibonacci retracement because even those who normally don't look at 38.2% or 61.8%, a lot of people look, like myself, look at 50% corrections. I really like 50% corrections, whether it's Forex or non-Forex market. So first of all, the market is near a 50% correction level from the Fibonacci, and we're essentially getting the retracement from the significant high here and the low over here. And next is at 2. What do we have at 2? I'll show you where the 2 is and make it a little easier. I'll put it in red. Okay, what do we have at 2? That's right, the doji. And because this doji is inside the prior real body, we have a bearish harami, correct? Okay, and that's what I circled in 3. And then finally, a resistance area. So we could see how the market pushed above resistance here, but didn't close above it. So we had a group of indicators, the Fibonacci retracement, the 50% Fibonacci retracement right here, the doji right here, the harami, which was right here, these two candlestick lines, and a resistance area. And once again, this just reinforces the fact that, the more signals we have converging at the same level, the more aggressive I would be on the trade. So let's move on to the next one. Okay, we're doing case study 6 now. And we're going to have a lot of subcomponents to this one also. So first, question 1, what candle signals one of trouble? Then 2, which is down here, why are these hammers likely to work? 3, okay, we have to go back to the top part of the chart again. What's happening here regarding the bull force? 4, and for that we have 2 parts. We have A and B. For A is the question is this a piercing pattern? Remember, we looked at a piercing pattern in the last slide. And then would you buy here? One of the important aspects is, yes, you could recognize a potential signal or maybe not a signal, but then what do you do with it? And 5 over here, any reason for caution during that rally? So let's put on our famous sign again, pause now, and resume when done. And for this one, we're going to have 5 parts to this because it's a 5-part question. Okay, so let's look at part 1. What candle signals warn of some trouble here? Now, both of these have a white candle. Remember the white candle, the bulls are in charge. And then a black real body. Now, this black real body doesn't wrap around the white real body, right? But it does get more than halfway into the white real body. So that is all together now, a dark cloud cover. So we have a dark cloud cover here. And remember, the higher the dark cloud cover should be resistance based on the close. So although the market pushed above it, here it didn't close above it, so the resistance is still valid. And interestingly, the next 2 sessions over here is another dark cloud cover. So back-to-back dark cloud covers. And keep in mind, you could have 50 dark cloud covers. It doesn't mean the market's going to fall out of bed. It does increase the likelihood of a reversal, and it should make that a more important resistance area. So the answer to part 1 is that we have 2 dark cloud covers. Why are these hammers likely to work? Okay, nothing is ever 100%, obviously, right? But we want the odds in our favor. So what's more bullish? And when I say bullish, meaning more likely a turn, because what are these hammers showing us to increase the likelihood of a turn? So answer is it's testing a support area. So for example, hammer 1 here, and it's okay to have this little upper shadow, is testing support. By the way, what candlestick signal is this in the red circle that I just drew? Okay, that's right, a bullish engulfing pattern. The lower the bullish engulfing pattern, which is actually over here, should be support. So we actually had a support zone over here. And so the hammer confirmed the bullish engulfing pattern. And that's the answer to the question, why are these hammers likely to work? We're looking at the first one now, is because it's confirming a support area. And with that in mind, look at the hammer at 2. Same thing. It is testing a support area. You can see how it got a little bit under the support, but didn't close under it. And to me, the market really has to close under support to say that the market broke a support area. By the way, this is not a hammer. Why? Because the upper shadow is too long. So the answer to this question is, why are these hammers likely to work? And the answer is because they are both confirming support. So let's move on to part 3. Okay, what's happening here regarding the bull force? Now, isn't the market making higher highs here, and mainly higher closes, or holding in the closes, the highs near the close very well? So, any signs of any problems? Of course. Okay, we have a series of small real bodies, spinning tops, showing us that although the market's holding the highs fairly well, the bulls really don't have 100% control of the market. And keep in mind, the market is not far from the resistance area set by the 2 dark cloud covers also. So the spinning tops, I don't think I'd be selling on them because, in my opinion, we're not quite close enough to a resistance area set by these dark cloud covers. But this keeps us out of a bad trade. One of the stellar aspects of the candles is it helps us avoid bad trades. So let those who use bar charts and see that the market's making higher highs or higher closes or higher lows go long. But now that we have the insights of the candlesticks, we would say to ourselves, hey, although the pound is moving up, it's doing so with small real bodies. We also have a couple, not major, but we have a series of some small upper shadows. I think we're going to hold back from the long side here and look at how much we would have saved from being long on this sell-off. Okay, and the answer is, as I mentioned, spinning tops. Just be cautious. Okay, let's move on to 4. Is this a piercing pattern? That's part A. And would you buy here? So, first of all, remember the piercing pattern has to go above the middle. The close has to go above the middle of the black real body. And obviously, in this case, it did above the middle of the black real body. So, the answer to this for part A, as shown here, is no, since the white candle didn't get more than halfway into the black real body. So we want to see with the piercing pattern, is the bulls really counterattacking, really pushing deeply into the black real body. Now, the second part of the question is, would we think about buying it here, although this is not a piercing pattern? And again, this is very subjective, but I would think about it because the market's confirming a support level set by not only the hammer here, but the prior lows here. Okay, remember, we talked about this in the prior slide. This is not a hammer because the upper shadow is too long. So we have a support level. So the market is near the support area, right around here. And this is also a fairly good risk-reward trade. So I don't see anything wrong with buying it here. One of the things we could also do, and we had touched upon this in the DVD workshop, this is a daily chart, but you might want to look at an intraday chart because we may have had on an intraday chart some reversal signals down here in the first couple of hours of trading, which could have given us a buy signal. So that's one of the aspects or one of the advantages of using intraday also, even if you normally don't. But I would see nothing wrong with buying it here. And my target would be the recent highs. Once again, my target might be very different than your target, so keep that in mind. But from my perspective, this would look like an okay risk reward. Okay, any reason for caution here? Now remember, if we bought over here, assuming it's a good risk reward, and it's just about 2 to 1, this is our target. Now, the market does this in this blue ellipse. Are there any reasons for caution to have us reassess, staying long, hoping to reach our target? And the answer is yes. Okay, it's a Harami. It's a small real body in a large real body. Now, also, there's a falling resistance line. Okay, I really place a lot of emphasis. I really like horizontal support and resistance because everybody's looking at the same level. But many people use angled trend lines. So, for example, here in this blue line, this blue descending line I made, this is a classic falling resistance line. Look how many times it was touched. 1, 2, 3, 4, 5, and 6. So we really have 2 reasons for caution here. We have the Harami, that is a candlestick signal, and we also have a classic Western signal a la the falling resistance line. Next, we're going to be looking at what I call what would you do slides. And what we're going to do is take a slide or chart, and on the last session on the right, we would ask what would you do based on the candlesticks. Now, normally when we do analysis at our shop, candlecharts.com, for our institutional clients, or at our seminars, our live seminars, we'll also look at Western technicals in conjunction with candlesticks. But we want to focus now on the candlesticks. So based purely on the candlestick signals, we're at this juncture here. This happens to be a daily chart. What would you do? So put the player control on pause. So here we have a bullish engulfing pattern. The market was in a little bit of a downtrend. And we have a white real body wrapping around a black real body. The opening of the white real body might be a pip or 2 above the close of the black real body, but that's still fine for a bullish engulfing pattern in the Forex market. But the more important question, or equally important, is not only the candlestick signal, but let's always think about the risk reward. That's where money management comes in. So by the time we get the signal on the close of the bullish engulfing pattern here, this is our potential target. By the way, this is a bearish engulfing pattern. The black wrapping around the white. Actually, it wrapped around 2 small white real bodies, particularly ominous. And so this is our potential target. Again, your target might be a little different, but I just look at immediately preceding highs and lows and so forth. Now, our stop out level with the bullish engulfing pattern is the low of the bullish engulfing pattern. So in the blue arrow, that's our potential risk. So we could see based on this risk reward, this would not be a trade that would be warranted. Now let's look at an example of another bullish engulfing pattern with the risk reward. So here in this green semicircle, we had another bullish engulfing pattern. And let's imagine that we don't know what happened after. In other words, we don't see any of this. Let's forget about all this stuff here. And the question is, this is a nice bullish engulfing pattern, nice insofar as it wrapped around 1, 2, actually 3 black real bodies. So we would say that's more significant as a potential bottom reversal. And we would normally say, or people who don't know that much about the candles would say, hey, look how well the bullish engulfing pattern worked. The market had a sharp rally after it. But in the real world, remember, we don't know what happened back here. We're only at this juncture. So we should be asking ourselves, okay, we have a bullish engulfing pattern. Yes, it wrapped around a multitude of black real bodies, but is this a good risk-reward trade? And to define risk-reward, we obviously have to first pick out what the risk is and what the profit potential is. So profit potential is those multi-tested highs here, and I would view this as a Harami. But even if it wasn't a Harami, we've had resistance here tested once, twice, 3 times, 4 times, maybe even here you can say it's a resistance area. So we'll extend the resistance zone to here. So on this tall white real body, although it's a classic bullish engulfing pattern that wraps around many black real bodies, this would not be a trade that's warranted. Why? Because if you're buying here, you're buying right at resistance, and that is not a very good strategy. Perhaps if you wanted to, you could break on the break above the resistance area here, think about buying it over here on this little arrow. Let me just make it a little clearer here. Over here. Because that would be a bullish breakout. And although the candlesticks are mainly reversal signals, nothing wrong with trading momentum. In other words, let the market break above a resistance area and go in from the long side. So if you did buy in a move above this resistance area, maybe when you saw this bearish engulfing pattern, it would be a time to exit. Remember, candles are really good for exiting, not only entering markets. Let's move on to the next one now. Okay, what would you do? So first of all, okay, we have a bearish engulfing pattern here, just to bring that out. Now, we're at this juncture here. Okay, and this red arrow. Question is, 1, would you buy at the arrow? 2, where is your stop? And 3, what are some targets? Remember, with 2 and 3, we're defining our risk-reward. Our risk is a stop, the protective stop, and our potential reward is the target. So, put the player control on pause, and would you be buying on that white real body? Okay, first of all, that white real body is a bullish engulfing pattern. See how this white candle wrapped around the small black real body? It's also confirming a support level, which is a plus. So we have a bullish engulfing pattern at a support area. So now, how do we get our stop? Well, the low of the bullish engulfing pattern is our potential stop out area, right? So that's our risk. So if we're buying it here, on the close, our risk is down here. And this looks like a really good support area because not only is it the low of the bullish engulfing pattern, but it's been tested numerous times. This happens to be an intraday chart, but it's been tested numerous times since this arrow over here, so quite a few times. So based on support, this would be our risk. And over here, something like that. And next are, what are some of the targets? And again, you may have different targets, but I'll show you some of the ways that we look at targets for our institutional clients. For example, this would be our first resistance, what we call R1, because it was tested quite a few times here. Next potential target would be just the pivot high here, the recent high over here. This is not a dark cloud cover, by the way. Why? Because the black real body did not get into the white real body. Nonetheless, it was a pivot high. And the major resistance, to me, a potential longer-term target, would be the high of the bearish engulfing pattern over here to the doji here. So we would call this R1 for our first resistance. This would be R2, and this would be R3. Now, some traders will like to look at angle trend lines. So although my first resistance would be here, remember we call that R1, okay, yours might be here. As I mentioned before, I'm not really big on angle trend lines. I like horizontal support and resistance much better. But if your target was here, if your first resistance was here, and to me that wouldn't be very important, but if you find that in your markets that you find angled trend lines work well, you would not do this trade. See, if your target was here and your stop was here, in your trading style, that would be a bad risk reward. You wouldn't do it. Whereas me, who will be looking at just recent highs, this is an okay risk reward because my reward is here and my risk is down here. So we can all define our potential stop out level at the same zone because we all could be using a bullish engulfing pattern as our stop out level, but the target is purely subjective. Okay, what would you do? And okay, assume you're flat. And I give you a little hint here. Look at the prior lows. In other words, these lows here. So put it on pause and we'll give the answer. Okay, so this green arrow is the same candlestick line we were looking at before. I'll show you here. It looks like around July 20th. So this is July 20th. The answer is, what would you do? And if you remember, we gave you a hint with the prior lows. So we could see this is not obviously this is not a hammer, right? Because that upper shadow is way too long. But although it's not a candlestick signal, the inability of the bears to hold the market under the lows, under those two red horizontal lines, is one of my favorite Western tools. Remember we talked before in some of the earlier slides about the falling off the roof where the market breaks above resistance and the bulls fail to hold it. There's a flip side. This is when the market breaks under a support area via those two horizontal red lines, and the bears fail to hold it. This is the famous crack and snap. And what's good about this is we get a potential target and a stop-out level. The stop-out level for the crack and snap would be the low of the move. The target would be the recent highs. And this happens to be a dark cloud cover because the black candle got deeply into the white candle. So this would have been a very attractive risk-reward. So this brings out an aspect that with a crack and snap, you really don't need a candlestick signal to confirm it. And by the way, notice this white candle here, wrapping around the black real body, bullish engulfing pattern. The low of the bullish engulfing pattern down here became support. Although the market moved under it, it didn't close under it. So the support area of the bullish engulfing pattern held, and then we had a Western charting technique, the crack and snap, giving us the buy signal. Okay, this next series of slides is really interesting, or are really interesting, so we'll go through them. Okay, so what would you do? And this is a multi-part slide. Okay, so first of all, we have a shooting star here. And what would you do? So let's put this player on pause and think about it. Okay, so here we have the shooting star. We're looking at the answer now. And in the red semicircle, obviously a bearish engulfing pattern. So we have the shooting star confirming the resistance area at the bearish engulfing pattern. So we have a grouping of signals. So do we do a trade on here? Do we think about a short sale? And let's think about the risk reward. Okay, now this market essentially has been in a trading range. See these two red horizontal lines? This is the bottom end of the range. So with the market at the top end of the range here, failing with the shooting star, we could expect a rejection of these higher levels and perhaps a return to the bottom end of the trading range. By the way, notice how the shooting star here, the upper shadow got a little above the resistance area of the bearish engulfing pattern. Doesn't matter. It has to close above it to say that the resistance was broken. So this did not break resistance. So anyway, based on the shooting star confirming a resistance area, the bearish engulfing pattern, and a price target to the bottom end of the trading range, this looks like a fine risk-reward strategy. Nothing wrong with going short here, because this would be we'd be selling it here, our stop would be here, and the target would be all the way down here, which is fine. Okay, now let's move on to the next session. What would you do? Okay, this is the day after the shooting star. And actually, okay, first of all, what pattern is this? Okay, we saw the shooting star, but now we're looking at the three candlestick signal. So what pattern is this? There's actually two questions here. And the second one is, what would you do? So put it on pause. Okay, so moving on to the answer. Obviously, hopefully it's obvious, it's an evening star. Three candlestick signal. An evening star comes after an uptrend, even a short-term one. Long white real body, the bulls are in charge. Small real body. And a black real body that gets deeply into the white candle. Classic evening star. One of the questions I'm asked a lot at my seminars is, which are the more negative candlestick signals? Which are the more powerful? And my standard answer, and the one I'm relaying to you, is you have to show me the chart. And the reason for that is because it's extremely dangerous to view candlesticks in isolation. We have to look at the candlesticks through the prism of overall market conditions. And this is a great example. Let me show you why. We would think normally an evening star has more potential to be a good short sale, right? Because we have the black real body pushing deeply into the white real body. So we would think it's potentially more of a good short sale than the shooting star, correct? But let's look at this. Before we saw the shooting star was a good trade because of the risk reward. Think about the risk reward if you went short on this evening star. Would that be a good risk reward trade? And the answer is no. Okay, remember, we still have the high of the bearish engulfing pattern here, and also now the high of the shooting star as resistance. So if we sell it here, our risk is, as shown in the red arrow, that's our risk. And remember, this market was in a trading range. So our target potentially is the bottom end of the trading range. So it looks like the risk reward is almost 1-to-1. That is not a trade to take. And this is a perfect example to show how, although the evening star can be a bearish signal, there are times when we would not take the signal as a time to initiate a new position because of the poor risk reward. So with the evening star, we would have not done the trade, but with the shooting star, we would have because of the very good risk reward on the shooting star. So the answer here is do nothing due to the poor risk reward. Now, what would you do here? So I've shown you the highs that the market made, the euro made in August, these red dotted lines. What would you do? And I'll give you a little hint. Also look at the highs in May before you make your decision about what you're doing here. So pause now. Okay, so let's go through this. So we could see that the market is above first resistance, what I'm calling R1. First of all, this is so small, it's a doji, and very long lower and upper shadow, so it's a high wave candle. So it tells us the prior trend, in other words, up, is losing steam. The trend is turning more neutral. What do we do here? You know, the market's above resistance, but we have a signal that the market's losing momentum. But is it really above resistance? It may be above this resistance, but remember I gave you that hint before about looking at those highs in May? It's not above this resistance area here. So this is one of those scenarios, by the way, that blue line is second resistance. So the market's above the first resistance area, but did it break this first resistance with a tall white real body here? No, it was a spinning top. Now, by the way, the market may have broken the resistance here, but it did it marginally. The next day is when we have this spinning top, this small real body, and then some confusion. So although the market's above the first resistance area, it certainly didn't do it with vibrancy. It didn't show us the bulls had full control of the market. And even if it did have a relatively tall white candle here, the market is not above the resistance area here at R2. So what would you do? In this scenario, nothing. If you're long, maybe take some profits, but I certainly would not sell short because, first of all, the market's at resistance, R2, with the spinning top. That might be a reason to sell short, but unfortunately, it's above this prior resistance area. So this is one of those times where there's no clear-cut direction, nothing wrong with standing aside. Now, interestingly, let's look at what happened after, what unfolded after. So as I show here, the market's above R1, but also near R2, so do nothing. So let's look at what happened after. This was the candle line where we said, what would we do? And interestingly, the market broke above. It ultimately did break out above the August highs, and also it did break above the May highs. We don't show them over here. And one of the great things we could do with the candles is, or on a candlestick chart, I should say, is use all classic Western charting techniques. This is why it's so important to use Western charting techniques, because with those, we can get measured targets. And one of my favorite targets is taking the height of the trading range. And you can see the market was in the trading range. The low is here, okay, right around 124. And the top end of the range was right around 129, maybe 129.5 in that area. So essentially taking the height of the trading range, and whichever way the market broke out, in this case it broke out to the upside, just take the height of the range. And normally, when we do get a price target, such as we had here, doesn't mean the market's going to stop. But interestingly, right at this price target, boom, what did we get here? The black candle wrapping around the white candle? That's right, a bearish engulfing pattern. So if we went long, let's say on confirmation on this white candle, sometime during this white candle, remember during this white candle, this is a daily chart, you may see something intraday here that would let you get in early on this trade rather than waiting for the close of the white candle. But let's say you went long here on this decisive break above this resistance area, and your target was over here based on the trading range, adding it to the breakout point, and then you get the bearish engulfing pattern, time to exit. Remember, as I said before, one of the powerful aspects you could do with candlesticks is use it to exit, especially when it's confirming a measured move. So I want to thank you for joining me, and I hope you found this informative, and may the candlesticks continue lighting your path to greater profits.